This program is brought to you by the Forbes-featured Freedom Hub Health Plan, the alternative to overpriced and restrictive insurance. The Freedom Hub Health Plan is exactly what you need. By Frequency Medicine Associates, supporting health professionals and laypersons with safe and effective advanced telemedicine-like technology that can scan and help rebalance the root causes of stress and illness. By the Planet Lockdown film, which can be seen on the Freedom Hub's Rumble channel along with many great speakers. And by The Pavilion, a 21st century community hub that brings together many of the disruptive innovations featured by the Freedom Hub, including direct pay healthcare, farm-to-table dining, TED-like Freedom Hub talks, and more. Visit your-mp.com/pavilion solution for details. Here we are. It's Thursday, Freedom Hub. We have a great show coming up. Jim Graypeck, I'm with my co-host, actually the host, the man, Charlie Froman. So for those of you who are new to the channel or want a little background or to see what we're doing, let me share my screen. And we have a website you can go to, your-mp.com. And here's a screen share. On the home page, go down to webinars. And it will take you right to here, the webinars to connect us. I think we need to get rid of that S, Charlie. Anyway, you'll see Wednesday and Thursday who our guests are. And you will also see 2 subscribe buttons here, which I recommend. We both recommend you subscribe to this. So then you're getting these on a regular basis and you can pick and choose. Below the bios, we also have who was here, our past guests, you can click through to. And the platforms we're on, the channels, BitChute, Brighteon, Rumble, and occasionally YouTube. I'm not sure if this show is going to make it, Charlie. We'll see at the end, but it's okay. So with that, let me stop the share and we can introduce our guest.
Yes, we can, Jim, and welcome, Frank. We like to feature libertarian entrepreneurs on this show. And that's really the only reason I'm having Frank on. There's other reasons. I was a client of his a long time ago when he started Everbank, one of the earliest, if not the first, online banks. And Jim, on my yearbook for high school, we all had to pick a quote. I picked Murphy's Law. One of his laws was, if you have a hard job, give it to a lazy man, so he'll find an easier way to do it. And to me, Everbank was part of that easier way to get control of your finances. And I loved it. And I saw somewhere in the news that Frank was a libertarian. So we started some email correspondence. And, I saw he was a hockey player. That was kind of cool too. So he's back in my life through LinkedIn. I'm seeing he's starting a new venture, which is very interesting, Battle Bank, because he's trying to do a couple things at least. One is make customers love banking through his bank, which is interesting because, banks get a bad rap often. And he's trying to broaden his offerings to customers in what they kind of want with the chaos of the market, and that's broader lending opportunities, broader investing opportunities around something that is an expertise of his, world currencies and precious metals. And along the line of precious metals, recently in LinkedIn, he highlighted his partnership with a pretty famous commodities investor advisor, Rick Rule. And we'll get into that. Folks may recognize that name. And he'll present whatever he wants, and then we'll get to Q&A. Some questions we'll want to have is, recently we had a heritage scholar warn us about digital currencies from the central banks. And let me share my screen real quick. I advertised today's event with an article about a warning from the Federal Reserve against crypto markets. Crypto markets are, controversial a bit. And in that same article, the New York Fed was announcing some partnership that might lead to its own central bank digital currency. which those of us who pay attention know that is going to enable some of the great reset behavioral schemes that combine with carbon footprints, medical passports, and behavioral scores. So we don't want that. And, we have a bank CEO on the call today, so we're going to ask him for his opinion on that controversy. Also, speaking of Rick Rule, people are scared of the recession that we're in and how we protect our assets. I'm sure Frank will have advice on that. As a CEO of an innovative financial organization, we'll want to ask him about the woke corporate stuff with ESG, environmental, virtual signaling, justice not for the individual but for groups, and being a good compliance person with governance. And of course, obviously, as libertarians, we want to ask about central banking and whether it should exist. That argument is at the basis of our country, specifically between two of George Washington's cabinet officials, Thomas Jefferson and the con, and Alexander Hamilton in the pro. And maybe he knows something about free banking. That's always of interest to us. And finally, what about his competitors, credit unions, et cetera? So that's my intro. A lot of topics to discuss. He wants to make customers fall in love with the bank. So take it away, Frank, and then we'll go to Q&A.
Well, thanks so much for the introduction. It's great to be here. It's interesting as we started looking at the environment, and was involved in the startup of Everbank that you mentioned, which really opened the doors in late 1999 as a direct online institution. And if you think about the time, rates were higher than they are today. Our first checking account rate was 6%, 601 actually. And at the time, the big banks and really all banks were paying essentially nothing on their deposits, charging fees. There were long lines in the lobbies, and client service really wasn't very good. And we had kind of looked out across the landscape and seen this and thought we could do something very different. Turned out it worked out that way. We're able to provide great values to clients, a broad array of things that they could do with their money. And then it's interesting, we kind of laugh for sometimes, as one of the first online banks, the times are different 20 years from now. In our customer service center back in 2000, 2001, and so on, the number one response to somebody calling in was take your cap locks off. Because people were basically on AOL with cap locks on all the time, and that was the limit of technology. And we really don't think about it that often. The iPhone was introduced in 2008, so people in 2000 to 2008 had limited exposure, unless they were kind of a wonky computer person like myself, to doing things online, to doing things on their phone, to doing transactions and so on in a different environment. And we ran Everbank for quite a while, joined with some great partners out of Jacksonville, and went public in 2012 and sold the company in 2017 to TIAA. And the second that the wire came in, I technically retired. And it's been great for 5 years in that time period. But about 2 years ago, Rick Rule and I got to talking. And TIA is its own institution. They paid for the bank, and that's wonderful, and they get to do what they want with it. But they had sort of abandoned the markets we served and de-emphasized some of the product sets. And they redesigned the bank to sort of take care of the people that they already had as mostly retirement clients. A little over 1.25 million individuals that TIA takes care of. And Rick and I talked about it and said, we think there's a hole here. We could drive a truck through it. We can go back and re-engage with our key target market. We can build a 2020s superlative front end and customer experience environment. Provide great products, get some talented folks who know what they're doing. And gee, why don't we do that? And talking to one of my old libertarian friends, David Galland, who was our first director of marketing at Everbank. We were on a horseback ride, way in the backcountry in Argentina, and got to talking about names. We're out for about 5 days with a bunch of gauchos in a remote area, about 10 or 11,000 feet. And when you're in the saddle for 8 or 10 hours a day, you got some time to talk. And I said, "Well, David, you're the marketing guy. What kind of name do you think we should come up with?" And he says, "Oh, I've always loved battle. You want to fight for your customers, deliver battle for better banking, deploy great interest rates, protect the keep, organize the troops." And so that was sort of the framework when we started to put the name together. And then what you can see behind me is a bunch of mountains. But in our corporate headquarters of Eagle County, Colorado, there's something called Battle Mountain, which is roughly behind my head. It's the least interesting mountain in the picture, but with the Gore Range behind it, of course, it looks pretty nice. So between the alliteration opportunities for battle and the mountain being in the middle of the county, I thought it was a great name. And at Battle, what we're really focused on is, first of all, people don't like their banks. We've been surveying people for the last year. We have a fairly large wait list. So if you go to battlebank.com, you can click join the wait list. And people that will let people know when we open, and we actually engage with folks. We say, "What do you really want from a bank?" But along the way, we've also asked people, "Do you like your current bank?" And 70% said, "I hate my bank." It wasn't just, "I don't like my bank." I did a talk in July that I estimated there's about $45 billion that banks had not paid people in interest in the first half of 2022. And coincidentally, the Wall Street Journal came out about 6 weeks later and wrote an article that said about $45 billion of money hadn't been paid to people in interest. If you go to the big box banks, look at your checking account, look at your savings account, you're not getting any value. They're probably paying 0.4, maybe a 0.1%. Most of them are charging a pretty sporty fee, particularly for balances under $15,000 to $20,000. And the customer service, it's interesting. Rick, who is a substantial customer of a couple banks, has gone into the branch locally, which he really knows he doesn't ever need to do, and asked a question, and they point to a phone on a desk and say, "Well, just pick up that phone and call those people. We don't really know what you're asking." And it's this sort of issue with branch banking is it's difficult to staff. There's certainly some great people in banks, but it's very difficult to staff a bank across 5,000 branches like JP Morgan Chase. And so our view is we're providing a single high yield cash account. Right now, with that price at a 3.25, 3.4, something like that percent, and you have full checkability. You want to write up 100 checks a month, you want to do online banking, you want to transfer it, you want to use your debit card, whatever. It's a great, simple account. And that's sort of the quick start. There are a few of the neobanks that provide a checking account or a savings account with a high yield. That's not that unusual, but we really believe that people should have the opportunity to diversify globally. And you mentioned initially the precious metals. We will be dealing in precious metals: gold, silver, platinum, palladium. People want to diversify their portfolio. And we'll store it for you, and hold it in custody for you. We'll ship it to your door. It's really a very straightforward business. We have a strong belief that this could be a hedge against inflation or disaster, depending on where we go in the economy down the road. Another element, of course, as you mentioned, is our foreign currency deposits. We'll have about 18 to 20 currencies where you can hold, whether it's New Zealand dollars, euros, Chinese renminbi, whatever. If you want to diversify your cash portfolio, if and when the dollar, you view that the dollar is going to be declining. And then finally, in that global markets group, we have something called market index deposits, and we'll survey clients, survey the market, think about what's interesting. And there's a lot of things that have opportunity, but people don't go into because they're afraid that they're wrong and it might in fact drop. market index deposit will allow for a principal protected deposit. For example, we give a guarantee to give you 100% of your money back in 3 to 5 years, but we give you a participation in the market of interest. Let's say it's the S&P or the gold index or uranium or something like that. You have a viewpoint it's going to go up, but you don't want to take the full risk, or you're doing it in a retirement account. So those market index will come out 3 or 4 times a year initially, and then get up to probably to monthly, but give you an opportunity to participate in markets with principal protection. And on the other side of the balance sheet, it's interesting. A lot of people hold precious metals as a key element in their diversified portfolio, but there's really very few opportunities to borrow against that if they need it they're going to build a deck, they want to buy more metals, they want to finance something else in their life. And we'll be making loans to individuals who own precious metals. It's one of the safest collateral pieces one can think of from a banking perspective, but it's very difficult to get a loan. You walk into your local bank, they're going to go, oh, I don't know, or bring it all in, and we'll hold it for you while we make you your loan. But we have that pretty well set up, as well as lending into some of the extraction businesses. Rick Rule has a long history of providing financing to resource extraction, gold mines and so on. And it's a very complicated, very specialized business, but it's something where there are not a lot of participants. They're intensely competitive, but this also helps on the asset side of life. And so that's kind of the quick overview of where we're going. It's a very high value, broadly diversified, and at present we're in the process of excuse me, writing from the ground up online account opening, mobile and web interactions for clients. So this is a brand new system. It's in development. It's actually in testing right now. So that when you come in to apply for an account, it should be very easy. The typical 5 to 10 minute online account opening process. Your mobile device will provide you with the ability not only to see your accounts, look at your values, do transactions. If you want to sell your euros or make a check or whatever, it's easy to do. And you can do that, of course, on the web browser as well. And our philosophy of service, too, I think is radically different than the typical bank. I think you get a lot of people that we've all called call centers, and you get somebody that probably was there 6 weeks ago and was just halfway through the training, and they don't quite know how to answer your question. We hire extremely experienced individuals who have been in banking for many years. And by doing an online institution, we can concentrate that talent. We have a number of people, and they may have been in Long Island or New York doing as a branch manager. So they've done this transaction 10,000 times before. So when you call in and say, I'm not quite sure what to do here, I want to have the following occur, they know how to do it. They've done it before. They can talk you through whatever you need to do, or just accomplish it for you. So I think between the value, the online experience, the great people we have on board, it really is the beginnings of Battle Bank. And we're really excited to get out. I think right now we're on track to launch in the second quarter of this year now. I'm still used to saying it next year, but it's coming up faster. Where, as I said, we're in testing. We have capital arrays and a lot of technology to build and a lot of numbers to plug into different slots. But it's going great. We've got a wonderful team. Just got off the all hands team meeting a few minutes ago, as I mentioned to you before the video. And we're ready to build. We're looking forward to being open. And I can tell you, based on the wait list, that people are very excited for us to open the doors. And so I'll turn it back over to you and go any direction that you'd like.
Thanks, Frank. Can you type in chat, or maybe repeat what the wait list link is, so folks can?
Sure. It's just battlebank.com.
Okay.
And then you can say join the wait list. We try to keep it simple. That's our sort of placeholder site. We're in the development, of course, of the full site. So battlebank.com. And there's a link at the top that says, join the wait list. Then the email comes to us, and then we'll about every other week, maybe every month, we'll give you an update as to what things are going on, ask you some questions, see what your attitude is about this, that, or the other element of banking. So it's pretty straightforward.
That's good. And folks, if you want to ask a question, please click the raise hand icon. Rich, I saw you had a question in chat, and I'll start with a couple. Why not local instead of you? There's a libertarian, Robert Shuford, Old Point National Bank here in Virginia. Why not him versus you?
Well, I don't know their offerings specifically, but I think if you look at the development of banking, and there's nothing wrong with going with a local bank. I think our value chain is probably significantly better. Local banks certainly can do it, but you have an overhead of a branch network. You have the overhead of number of people in market. It typically is something where you can't give that back to the client. We'll be scaling over the next few years after we open. And that allows us, again, to provide better value back to the client. And I think we probably have a more diversified offering set. Again, any local bank could do it. It's just a matter of whether they choose to. And I think one of the key advantages that we kind of have a joke that we can't compete with JP Morgan Chase, and they can't compete with us. And I think what we have is the team members that are sophisticated to deliver the really complex and or interesting product set, which is different than most local banks. But a JP Morgan Chase or a Wells Fargo or a Bank of America needs a gigantic market to care. So we can provide value in markets that are certainly large enough for us to care dearly about, but for which we also have the sophisticated personnel to deliver the product set. For example, in the extraction lending business, it's just different. And JP Morgan Chase probably doesn't care because it couldn't build a big enough portfolio. And most local banks can't do it because they don't have the sophisticated personnel. So if you take a look at the value of your local bank, that's great. More power to them. But I think as you look forward, obviously the number of banks has dropped about in half since 2008. And that reduced number of banks is partly because it's very difficult to compete from a smaller institution, both from a cost perspective and, frankly, from a regulatory burden. Some of those regulations we should be doing, but of course they're imposed in the banking world. So it's just difficult to do it these days. And I think we're able to provide a better value, a broader product set, and frankly, and a great number of folks that you can talk to if you need to pick up the phone and call.
That makes sense. Why not BB&T, John Allison's bank? And I would guess your answer is Allison's philosophy no longer is there since they were merged with Truist. So that libertarian mindset doesn't exist anymore.
Well, I think there's part of that. And again, it's a value thing. We always appreciated his approach. And when we were with Everbank, it was they were direct competitor in some of the markets, and they did a great job. But it's just like any other business. You do have to eventually make a decision who you're going to hitch onto. And if BB&T, I would tend to agree that the philosophy is not there anymore. But it's also a value proposition. They're also a large branch network bank and have that cost overhead that is a little difficult to provide the value back to customers.
Okay, I'll pause. Jim, go ahead. You can.
Am I muted now? Okay. Hey, thank you, Frank. A couple of kind of questions or comments. And I'm in that 70%. I hate my bank. The people are nice, but it astounds me that the level of, I would say, incompetency. I mean, for example, it's been 2 months trying to get paperwork from another branch to my branch so I can be a signatory on something. I mean, this is, and it's right. They're like, you have to call get on the phone and call business banking. I'm like, anyway, but related to that, regulations, and I guess you're going to avoid that somehow, which is great. and stealing from people, Wells Fargo, et cetera, et cetera. Are there regulations, I mean, in place that I'm thinking there must be, that you really can't do this stuff? You can't, against gold or, whatever other commodities. But are you struggling with regulatory hurdles or no?
No, there actually our regulatory relationships have been great, and there is no regulation against it. In fact, in the original Banking Act in the late 1800s in the U.S., and it's been followed through. Bullion is actually has a special place in that. Of course, that occurred while the dollar was still linked to, at the time, silver, later gold. But no, there's no regulatory issue with lending against precious metals. And again, I think it's one of those, it's too small a business for the big banks, it's too big a business for the little banks. And you really, John, I see your note there, the dollar was silver. That's correct at the time when the Banking Act was put in place. And of course, the 1892 election changed that. Everybody in Leadville remembers that very well, as went from the richest city in the country to pretty much of a shanty town. But the regulatory relations have been great. The people are honorable, ask good questions, and so far it's been good to work with. But I think part of that's because our team has significant experience, and their job, whether various people could debate whether or not they should be there, that's fine. But their job is to be somewhat of a fiduciary, and they take it very seriously. And they, as I said, they've asked good questions and provided good feedback.
Let me, before you go, Charlie, one thing. I'd like to get your vision of what the future of banking not will be, what it should be. How do you see it, so we can all have better relationships and so on?
I think most of it, obviously our vision of what it should be is definitely tied to direct online non-branch institutions. It's not going to happen overnight. I mean, in the early 70s, we heard about a cashless society. Well, here we are, 50 years later, and not there yet. But I think, barring a solar EMP, we're going to continue to have more and more online, electronic-based financial services, and the scale and the efficiency is just going to continue to get better and better and better. There's some, corporate oligopolies that sort of slow that progress down. The Visa, MasterCard, American Express complex will impede that for years to come, but they also help us to get things done on a day-to-day basis. So you can run your credit card or debit card anywhere in the world, pay for something, pay directly, use your Google Pay, Apple Pay to move money, your Venmo, your PayPal, whatever. But I think our vision would be that it is going to trend significantly towards direct banking like Battle Bank. There will be some local banks that have specialized focus. If you're just doing whatever community you're in, there's a special issue there. That's where they can take an advantage, be entrepreneurs, and meet that question. But I think banking is very definitely moving in the direction of online. And you look at something like the big banks, they really have to fill in with massive amount of fee services. Obviously, you mentioned Wells Fargo and some of their issues. Was really around fees. And, frankly, that's a compensation system problem. People do what you pay them to do. It's kind of a trend. And so if you tell them you're going to pay them to do X, Y, Z, they're going to do it. And that's how you get in trouble. But I think, banking is going to be more frictionless, easier to do, simple to move money, to really accomplish what you want to do on a day-to-day basis. We sort of think about 200 or 300 years ago when we were all carting around coins or wafers or shards of metal. That's a lot of work, and it slows things down. And maybe things should slow down. Who knows? But it's so much easier just to jump on your bank or Venmo or whatever and get a transaction done these days. It's just going to get better.
And the central bankers are going to disappear, and it's going to be independent guys like you that are going to keep us safe, right?
Well, I think it'll be interesting where that goes. Obviously, the 1913 era was a tough year, and I don't see that going away quickly, whether we want it to or not. It's interesting. We would tend to think that self-policed industry groups should be the way to go. Unfortunately, just in my banking lifetime, there have been 2 or 3 issues where the private funds, I think Maryland was probably the most recent one, where the actual private insurance funds went broke. It's about managing that process. It's an insurance company, really. If you do it right, you do it privately, that would be wonderful. I don't see anybody stepping up to the plate really to do it at this point in time. And maybe that's an opportunity for somebody down the road. I'm getting too old to start one myself, but I can do a bank because I know what I'm doing there. It would take a long time to put together a private insurance deposit insurance company. Current regulation in the U.S. is that if you are a bank, you have to have FDIC insurance. Of course, that wasn't in place in the 80s, and a number of non-insured banks went down. And of course, the customers lost their money. And when people lose their money, that tends to invoke statutory relief. So,
Okay. Charles.
Really?
Let's continue that conversation a bit, if you don't mind, Frank.
Sure.
Some of the libertarian stuff on financial reform. When I was lobbying for, I forget who, there was this Wisconsin representative who had a bill that never got any support, but it always intrigued libertarians because maybe it dealt with that private insurance company you mentioned. He called it cross guarantees. I wonder if you want to talk a bit more about that for the future, because I know these big ideas aren't going to come anytime soon, but a lot of us do want to end the Fed. We do want to oppose central bank digital currencies. And we do want to privatize deposit insurance and all the rest. So do you want to talk a bit more about that? I mean, I know you have to be careful. I don't
know what the cross guarantee principle was. Is just that all banks cross guarantee all their competitors, or?
Bert Ely, he was a big fan of that. He was a big libertarian scholar in DC for years. I remember I invited him to present to the mortgage brokers for whom I lobbied back in the mid-90s. There's not too much meat to that proposal because it's pretty obscure. But the whole topic of replacing the Fed and the FDIC and all that is obscure pretty much too, because it's such a pipe dream. But if you had more thoughts on that, this is the place to lay them out. Yeah. Or do you have to be careful as a CEO in the business because you work with these regulators?
No, I mean we're in, as I said, we have great relationship with them, and they're doing their job, and they're doing a good job of doing their job. And they don't. My debate wouldn't be with them. It's perhaps with some of the principle of the entire structure. Could you build a private insurance? Of course you could. It would look like a large AIG, New York Life, whatever sort of operation. And in some respects, the banks have bootstrapped on top of FDIC insurance today. There are a number of companies that will essentially you're participating deposits out of it. If you give me $1 million instead of 250,000, I'll trade 750 of that with 3 other banks, so that now you have FDIC insurance for your entire amount. But it's not all on my balance sheet, even though as far as you, the customer, are concerned, it is. It's sort of a participation in the back, and that's an active market, and a lot of people do that. And yeah, you could start a private insurance company. definitely would be a massive undertaking. I don't know if you could do it in the U.S. legally. You'd have to lobby for the opportunity or have a statutory reform that would allow you to do it. And I think statutory would be probably the way it would have to occur. And I think the key, of course, is honest disclosure to customers. Customers are certainly responsible for doing their own due diligence, but I think a lot of the requirement has come from people playing hard and fast with the rules. Just forgetting to mention that there is no insurance and the people don't know to ask. If you have proper, we all agree that you shouldn't lie in your advertising. I think a lot of people were doing that at the time, and that's what created some of the statutory elements. But sure, I mean, you'd love to have a private insurance. There is an equivalent of that on the brokerage side. A lot of people have the SIPC insurance, but then there's privately insured on top of that. And if you go to a major broker dealer these days, they're going to tell you that they have additional insurance. And if you're large enough and you ask them for it, you can get that policy. So certainly in principle, it would be great. I don't see a pathway in my lifetime to get there, even if I have perfect life extension for another 50 years. It's going to be tough, but if maybe you should lead the charge and start one of those companies or get the statutory relief to allow that to happen.
Pipe dreams haven't been a barrier to us advancing big ideas. So
we understand. I love the big ideas.
What about a life without the Fed? How would that look?
I think a lot of these questions, there's everything from balanced budget to life without a Fed and so on, is you can kind of see the end game in a lot of them, but I don't know what the transition looks like. You can come in, balanced budget is kind of the easiest way to look at it is, somebody comes in and says, we have to have a statute that we're going to balance the budget. But right now it's $2 trillion deficit and $31 trillion in outstandings. So how do you get from A to B? In a day-to-day basis, the primary relations that banks have with the Fed are through Fed wire. Obviously, the Fed has all these other activities in the money markets and creating money supply and so on. But day to day, it's really running Fed wire, and that could easily be replaced from a banker's perspective. You mentioned free banking, which I guess stopped around 1880, more or less, with some of the which is when the Banking Act came in. Again, great, an interesting way to do it. I guess in a way, some of the cryptocurrencies are attempting to reinstitute that in their own way. But people want to find a place to store value. And whether it's free banking, a crypto, different from the Fed type of asset, that's where you have to go. And if the markets want it, somebody will find a way to deliver it. And yes, regulation can shut it down, but typically regulation only comes after fraud or large numbers of people lose money. So I think I think we all know that's what's kind of occurring in crypto today.
Charles Ford.
Yeah.
Good morning. Thank you. A couple of questions that I've got is, what is your view on fractional banking and fiat currency? And is that not really the cause? You just mentioned the fact that people are looking for value. And that's because there's no value in any currency today. They're all fiat. I just would like your comments on that, and thank you for your time and trouble this morning. This has been very enlightening. The other question I've got or observation is, I'm an ex-insurance guy. There is no such thing as the FDIC. They can put all the placards out they want to, but it's illusory coverage. For an insurance company to exist, it has to have a balance sheet and financial statement and have a state of domicile, none of which the FDIC has. Secondly, the FDIC you say you get 250,000 protection. Yeah, not exactly. The Federal Reserve determines after a bank failure what amount, if any, will be paid, and reserves the right to adjust that as they see fit, not subject to anybody's review. Now, most places in the traditional world consider this nothing more than a fraud, and that's what it is, and that's what most government monopolies become. And I just wanted to point that out. But if you would address the issue of the reserve, the fiat currency, and the fractional reserve banking, I would appreciate it, and thank you.
Sure. Thanks for the question. I think fractional banking is obviously what we have today. And if you sort of flip it on its head, prior to the 1692 introduction of checking accounts in the Netherlands, non-fractional banking is I'll take your gold, or in this case, I guess your dollars, and hold them, and I'll charge you a fee to do so. Because without fractional banking, I don't really have the ability to pay you anything. It's really just a storage fee at that point. It can't be really loaned out again, because in non-fractional banking, I have to keep it all inside the house. I think the things that we're focused on are a couple of things. One, obviously we will have some leverage, but we're maintaining a high capital ratio just by principle. Two, dealing in precious metals allows our clients to have something that isn't fractional and has a value. A lot of our clients have a viewpoint, and I suspect you do as well, that holding a precious metal is real money, and something that should be held both as a hedge but also as a principal in the long run. So do we create money supply when we make a loan to somebody? Sure, a bank does, and that's something that, like the theory of relativity, is always hard for us to get our heads around. But by maintaining your deposit balance but still providing a loan, we're actually increasing the money supply at any given point in time. And I think it would be interesting to see if somebody could put together something that is purely non-fractional. But again, that barks more like a trust company, where I just say, I'll take your dollars and hold them for you and give them back to you on demand. But I'm not going to loan them out, so I'm going to charge you a fee of X to do so. So it's really not a business model that's in practice right now, except in the custody of precious metals and other assets. Hope that at least fractionally answers the question.
Charles?
Thank you very much.
Rich, I saw you wrote something in chat. Do you want to ask a question and unmute yourself? Rich Keel. And while he decides whether he wants to, what about, I've asked you a lot about what about questions. What about credit unions, another version of local banks? How do you feel about them? I know when I was lobbying for the federally chartered credit unions, banks complained about the non-tax status of credit unions, and we always had our talking points in rebuttal. And it's interesting, you said people don't like their banks. I sell health insurance, but people don't like health insurance, and so I don't really sell it anymore. I sell the credit union version called sharing. Mm-hmm. And Forbes feature how we combine it with HSAs. So what do you think about credit unions?
I think I kind of love all financial institutions into one. Of course, I would love to have a level playing field, but that's frankly not a big problem. The credit unions as a collective typically, serve the community that they're in very well. There's a lot of elements that probably, car loans and house loans and home equity lines that probably wouldn't get done a different way if you don't know the neighborhood, you don't know the local goings on, don't understand what the corporations locally are doing. We might not be able to serve that as effectively as a local credit union. obviously, as typical, I know there's been a lot of consolidation and some of them are getting quite large, and they've certainly eased the rules on what qualifies as a member over the years. It used to be you had to work for Boeing, in our neighborhood, or McDonnell Douglas is what was the St. Louis crowd. But now it's, anybody who's ever driven by McDonnell Douglas facility is eligible as a member, or lives within a 500-mile radius. But no, I don't have a problem with credit unions. They do a good service. They take deposits, they make loans to people, and a lot of things get financed that way. I think that's a great service. I have no issue with credit unions or banks or savings and loans or anything else, as long as they're operated honestly to the client. That's fantastic.
It kind of messes with your answer about local bankings finding their niche, and you're diversifying in a completely different direction. And let's go there. Give me a hypothetical customer with a certain deposit, and how you're going to divide it among these unique accounts. Currency plays against the dollar, precious metals to hedge against we like to call it the Great Reset, aggravated recession. Yep. And these extraction-based plays. All this sounds really fascinating. Can you give me a hypothetical distribution into different accounts to protect me?
I think, from your perspective or a client's perspective, to me, the focus of, and I'll just sort of talk about how I look at my own bank, and I think it translates to a lot of other people, is the high yield cash account's really the core. I get a great, market rate of interest. I can do any type of transaction in that account. And that's my storehouse of US dollars. I mean, at the end of the day, those of us in North America, and we'll have clients both from Canada and the US to start with, and then diversify internationally down the road. We eat food that is paid for in dollars, and we buy cars in dollars, and we buy houses in dollars, and so on. And even in Argentina, where we spend a lot of time, you buy houses in dollars because the currency is so disastrously bad. So that high yield cash account is really where you begin. And then, a lot of this depends, of course, on your view of where the economy is going. You can take a typical diversified portfolio for your average person is still going to be, if you look across the industry, it's still going to be, 70% probably U.S. equities, and 20% fixed income, and another 10% in cash. You can make your own judgment. I always ask people when they are buying some precious metals, what's your view of the future? Is it that you're just doing this just to diversify, or do you think we're going to be purchasing bread with gold coins in 5 years? And that changes what form you're going to want to hold that precious metal in. So I would diversify. I think foreign currency deposits are part of your cash portfolio, whatever diversification. So if you have X% allocated to cash type items, a portion of that should be in currencies. And to Mr. Ford's question, all of them are fiat currencies. So you really are picking whoever is going to be slightly a winner over the next 3 to 5 years. We don't have a philosophy where you should be trading currencies. It's really a diversifying asset. And then precious metals should always be a part of a portfolio. I think some academics would say, is that 5 to 10% of a portfolio? We've seen some of the major broker dealers at times be up at 30%. I don't have a personal passion as to where that should be, but it should definitely have some on board. And you listen to somebody like a Bill Bonner, maybe it's a higher percent than even that. So yeah, it's diversified across those things. And then when we're lending the money out, whether it's to precious metals or to extraction or to just everyday businesses, we're going to have some balance on the balance sheet. We can't have all of it in one thing. That would be very smart. So we'll see where the market goes. I think we're going to have based on our wait list, we're going to have an excellent number of precious metals loans on the books. The extractive business is really a street fire business. We have to get in there and make the deals. So we could be extremely successful there, or if some of the competitors are tough, we may just be sort of in the middle. And then our chief credit officer has experience in a number of other areas that we'll probably pick up either as filler or to diversify the portfolio. But we'll have a balance. I think the way our projections look, which are private, it looks like we're going to have a very good, scalable, high value business in 3 to 5 years.
And how chaotic do you predict the economy such that your broader offering is going to become even more critical for the discerning customer?
I think it could become very chaotic. I think there's sort of two. Well, of course, there's a lot of trains of thought, but I think there's two that we sort of are paying a lot of attention to. One, that the cavalry will still come to the rescue again and try to push it out 2 or 3, 4 more years. Stop raising rates, start coming back in and doing all the things that we would have objected to, over the last 8 to 10 years. At which point things kind of level out, don't go anywhere in a hurry. We get kind of a 1970s stagflation sort of environment, and go on. And there is the opportunity for this to actually be an economic reset. That things could just go downhill radically, and then the businesses that should go out of business will go out of business, and the businesses that shouldn't will stay. That would be pretty chaotic, but I think our product set will allow customers to hedge themselves against some of the problems. Holding precious metals, holding other foreign currencies, or foreign currencies, and just getting a high yield on the high yield cash account, is all of which are important for a client. And again, we're very conservative. We're not going to have a massive derivatives matchbook that creates potential issues. That's where I see some of the biggest risks in the financial system. Is taking the capital, taking the client deposits, doing regular loans, but then having a huge matchbook of derivatives on top of that. With us, some of the big banks have a 6% capitals to play with, and if you have a matchbook stacked on top of your balance sheet, that doesn't leave a lot of room for protection if things go south. And I think AIG certainly experienced that in the 2008 period, Lehman, Bear Stearns, and so on. And it certainly could happen again.
I have a quick question, if I can jump in, Charles. A lot of people are talking about, all the time I hear this at parties, whatever, what do you recommend is the best place I put my money? Like, should I just hold cash? Should I get precious metals? Should I buy real estate? That's right. That's a typical, with everything kind of up in the air, everyone's wondering, oh my God. I had a guy that's like multi-millionaire telling me he's never been scared in his life, and now he's not sure what to do. Which I can't relate to that. But anyway, what do you suggest these days, or what would your advice be, if there is any, or if you're allowed to?
So the way I approach it, and I guess that's his way, is to be diversified. Do you ask all those questions? Should I be in X, Y, or Z? And you just say yes. You probably should be in as many of those as you personally can afford to be in. I think my experience is that predicting the market is like being an astrologer. It was an interesting Fed study, St. Louis Fed study in I don't know if it was the late 80s, early 90s. And they looked back over a very long period of time across, I think it was the Wall Street Journal's poll of economists at the beginning of January every year. And they asked a simple question, which was, what will the rate of the 3-month T-bill be at this time next year? And the study actually only focused on the sign. Is it up or down? Let alone the actual number. And they found that all these professional economists, and I think there's 20 or 30 in the poll, over a long period of time, were correct as to sign only 42% of the time. So less than a coin toss, just on getting whether it's going to be up or down. So predicting the market, to me, is just a fool's game. It's a great conversation starter. We all want to talk about it.
Right.
So my view, when you talk about where should people put their money, is diversify. You're not going to be right, but you want to be right somewhere. And precious metals are a good place. Real estate's a great place. Stock market might be a good place. Fixed income might be a good place. But diversify, because we're absolutely not going to be right. And it's just a matter of making sure you're right somewhere by diversifying. I had a couple great conversations with a guy named Bill Sharp, Nobel Prize winning economist, and he's like, I just diversify. I'm not smart enough as a Nobel Prize winner to pick the markets. I've got money in a lot of different places, and I'm pretty happy about that. And he was 70 or 80 at the time, and just quite happy about it.
Thanks.
So, Frank, in closing, why don't you give your website again, how folks can get on the waiting list and how folks can reach you?
Well, our website is battlebank.com. There's a variety of places where you can join the wait list, ask to be put on the list to talk to be a future team member down the road. And we provide updates there. The wait list, if you join the wait list, we'll be providing updates to you either every other week or every month, just to see where we are. And we'll certainly let you know when we're going to be open. And we'll ask you some questions. We'd like your participation. So if you have a viewpoint about what we should be offering, what it should look like, feel free to let us know. And you can always just email it info@battlebank.com. That gets you to the marketing group, and they'll take care of collecting the questions and hopefully getting back to you with a good answer.